Dan, good morning to you. It's great to have you with us. I remember you were talking about Meta not too long ago. You liked it at its valuation. What do you think of Twitter right now, trading at 34 bucks and change?
You know, it's just too much drama for me, so I'm not involved at all. And I plan on staying that way.
So even the drama will make you look past a good valuation, if it is?
I don't think it's a good valuation. I never said that. I just said that the drama is keeping me away from it. I think one big mistake people making in this market in general is assuming because a company is down 70, 80%, the downside is still 100%. It can always go to zero. So I think you need to kind of remember that right now when you're looking at a lot of these valuations, where just because it's down a lot doesn't mean it's cheap, especially if you're going into a recession where numbers need to get a cut a lot more. And don't forget, Twitter, along with Google, along with Facebook, along with all these ad names, you know, they depend on advertising revenues. And in a recession, the last one we had, you know, real size, 08, you know, ad revenues went down for the industry about 18% or so. So you still got a lot of estimate cuts in front of you.
Hey, Dan, yeah, I'm always trying to figure out in these kind of exciting, distracting narratives what the lesson is for the retail investor. And it seems to me this is about Elon Musk trying to get out of a bad trade. I mean, he signed a deal to buy Twitter at $54.20 a share, and now it's 20 bucks less than that. But also at the same time, you've got VCs these days, and we're going to talk about this in a bit, trying to buy beaten down growth stocks here. For example, HashiCorp, back in March 2020, did a Series E at a $5 billion valuation. It's only $6 billion here. So what's the lesson for the retail investor about the so-called smart money and buying high versus not?
Well, you know, you have to remember, we entered this year saying we think the S&P is down at least 20%. And then in May, we changed that to down 30 to 50. And I think the thing the retail investor needs to remember is the last 13 years were not normal. You had the Fed, every time the market went down a little bit, going ahead and increasing stimulus. You have the government doing the same thing. That's not normally how this works. During a recession, it takes you at least a year, sometimes closer to 2.5 years, if you look at the tech bubble, for the S&P to find its ultimate bottom from its ultimate peak. So there's a time component of this that I think people are forgetting what is normal. And with the Fed now actually in the mode of cranking up rates, despite growth slowing, it's probably going to be worse than normal. So I think the lesson for the retail investor is, if you want to have some fun, like going to Vegas, sure, go ahead and speculate on Twitter or crypto or something. But if you're trying to make money over the long term and you can't afford to sort of use this as entertainment, you need to go back and study history, look at valuations, look at earnings, and try to find companies with good cash flow and recession resistance, or just sit in cash. I think, you know, I've said this multiple times on your show, you know, losing 5 to 7% to inflation is way better than losing 30 to 50% to a stock market correction, unless you're just doing it to have some fun.